the emptying office spaces because people are not going back to work. I mean, this is not an ordinary recession. The Apple says they're not going to go back to work. Look, all the office buildings empty. And, residential real estate depends upon jobs. Do you know what I mean? If you're saying recession means a loss of jobs, which Amazon's laying off, what happens to real estate wherever they have an Amazon office? So this is the ripple effect. May 23rd, 2022, so it is. I don't remember where I'm anymore. That was one of the biggest announcements I ever heard, that the IMF is saying the world faces one of the biggest economic challenges since World War II.
Well, the inflation episode we had in the late 70s was driven by demographics. That was the baby boomers entering the workforce all at the same time. It was the largest demand shock the world had ever seen. And we had a supply shock of this oil crisis of the Arab oil embargo. That's not repeating now. What is actually more similar is 1974. 1974 was the Arab oil embargo. The price of oil tripled and interest rates went up. Inflation shot up. And the immediate effect was the economy went down the toilet. Almost do not pass go. The stock market fell 50%. And the ISM survey, which is a good guide to the business cycle, it's the Institute of Supply Managers survey. Anytime it crosses below 50, suggests the economy is getting weak. A recession comes at about 47. It hit 30, which was the lowest in all history. And it happened in a space of 4 months. It went from roughly where it is today, which is around 55, and went to the lowest level in 4 months, based on exactly the same kind of setup we've got now.
So are you saying that the 70s are now pretty close?
Yes, and inflation fell in 1974 afterwards. People are still thinking inflation goes on forever. It did not, and it did not in the 1940s either. Then the next one up is 1984. 1984, we saw an issue where global trade, there was a huge amount of trade disputes. The dollar was pretty strong, like it is now. Interest rates were going up, and inflation was high. And everybody was fearing, looking back and saying, oh, we don't want the early 80s, late 70s again, the inflation. So Volcker was tightening rates too much, and the economy collapsed. It didn't go to recession because the Fed quickly started cutting rates, but the dollar went up a lot more and created a lot more problems. We ended up with the Plaza Accord in 1985, when everybody had to stop the dollar going up from destroying the global economy.
Right.
So then the next time we see something similar was 2008. 2008, if you remember, the oil price was at $147. Inflation was 6%. The Fed had been cutting into that because the economy was imploding. 2018, exactly the same. Oil prices high, inflation high, the Fed were hiking rates, trying to tighten the balance sheet, and what happened is the economy rolled over really quickly again. Okay, so what's going on here? Why does this phenomena keep happening? Everyone extrapolates inflation out forever. What actually happens is that consumption falls because we've tightened monetary conditions. So tightening monetary conditions to ordinary people means the cost of your mortgage has gone up at the fastest pace in history. Over a 1 year period, mortgage rates have never risen this fast. So any money you borrowed has suddenly got much more expensive. Your wages haven't kept up with the cost of just basic services like food. So you're actually feeling poorer. So you can't consume as much, and you start not consuming other things. People overextended on housing because they rushed into housing in 2020 and 2021, and the rates have gone up for them. Also, just the rise in things like the cost of oil has meant that, gas prices, all of this stuff, and then the rise in the dollar, which is a monetary tightening. All of these things get together would suggest, and I put them on a chart, it suggests that the ISM is going back to 30, which is as it was in 1974, which is a terrifying fall. Now, what
does ISM stand for?
Institute of Supply Management. It's the survey of buyers at corporations who buy goods and services. They ask them, what is your read on the economy? How much inventory have you got? What are prices paid like? That kind of stuff. And they create these surveys, and they're readily available online, and you can have a look at them. And they go up and down with the economy. They tend to lead the economy. And it's suggesting that if we're not careful, we could have a very sharp, nasty recession, meaning kind of a negative 5% GDP recession.
Right.
That's right.
Basically, it's called debasing the currency, which the Romans and Chinese already did.
Yeah, because don't forget, the debasement of currency works in a simple way. If you're really thirsty and I have a bottle of water, you'll pay anything for it. If you're really thirsty and I've got 5 bottles of water, you're kind of thinking, yeah, I probably need some of that water, I'll buy them all, but at a lower price. If I say, here's 1 million bottles of water, you don't want any of it because there's too much water now. It has no scarcity. So if you make too much of something, it becomes less valuable. So if Da Vinci had created 50 million pieces of art, guess what? They're worthless. And so it's that concept. And what it does is, if something gets devalued versus something else, so we're not making more shares in the S&P. Actually, what we're doing is buying them back, making less of them. Therefore, the S&P goes up. Real estate. Yes, there's periods where we try and create new real estate, but generally real estate prices go up versus the Fed balance sheet because it's a relatively scarce asset. Same with gold, same with crypto. What choice do you give people? Well, you're going to get destroyed because of the supply chain issues, because of COVID and all of this, and your wages won't keep up. So we're going to destroy household net worth, and everything's levered. So all the borrowings against houses and all the borrowings against equities and all of the borrowings on top of borrowings, and you're going to let the collateral go down and blow the entire thing up.
But isn't that what they're doing when they say they're going to pay off the student loan debt? Because if there's debt, there's also
that's debt forgiveness. That's MMT, right? Which is coming, whether we like it or not. Again,
okay, I understand that.
So what you're trying to do here, what they're trying to do is reduce the debt via financial repression, which is you basically have inflation running slightly higher, so you have than interest rates. So what you want is to reduce the real value of the debt. So if you think back to your parents, how much they paid for a house and the mortgage they had, the mortgage seems laughable. It's because over time, inflation raised the value of the house and the debt doesn't get raised. So in the end, the debt is nothing. So
the way that is this stuff here, make the money less valuable.
Correct.
Oh.
It makes the debt less valuable.
Right.
So it's okay if you're in debt, but if you're borrowing, if you're lending money, it becomes complicated. But anyway, the point being is you either have a fiscal stimulus, which is, let's say, the Republican view. We'll have a fiscal stimulus, cut taxes, and we'll put some spending. And what happens is that doesn't go to the people who are the worst off. So it's creating this issue of 1% versus 99, which everybody can see and nobody knows how to solve. The issue is actually the balance sheet, because all of the expensive assets keep going up because they keep printing money.
The rich get richer.
The rich get richer.
Yeah.
But doing this blanket fiscal stimulus is hard because the rich get richer again. So I think people have thought, well, maybe we should just try and give it directly to the people who are most affected. Okay, fine. Those are the two choices, or you do nothing, which is too late because there's too much debt. So you can't let the system clear anymore. The old way would have been you let the system clear, it's all okay, you just have a recession, everyone stops borrowing as much money, blah, 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 blah. The world is 400% of GDP in debt. The world has never been this in debt in all economic history.
Raoul, I hate to say this, I'm seeing your point of view.
Yeah, and what I'm saying is, regardless of your philosophy, it's difficult to find other outcomes that kind of make some sense. So let's go back to the 1940s now and figure out how bad it was then. This was the very similar setup, the worst supply chain issues, massive inflation, everybody coming back in. Well, what happened was the economy collapsed. Then interest rates came down and they stabilized. And they stabilized because the Fed stabilized them. Oh, and inflation was running slightly hot, 3%, and bond yields are about 2%. So real rates, meaning you in the property market, are going to make a lot of money. So negative real rates become very good for assets. And what happened in the 1940s and 50s was a massive economic boom. What we actually got was the value of the war debt eroding because of this financial repression. We had the value of assets like housing. The equity market went up 900% over that period of time. There was a lot of fiscal stimulus because you had to rebuild after the war, and companies were building factories. So if you think of now, companies are going to be rebuilding factories in the United States or in Europe and not in China. So that's going to add some stimulus. Yes, the jobs are not there. It's robots in the factories. But